The world of finance is a fascinating and complex one, full of opportunities and pitfalls. It's a realm where fortunes can be made and lost in the blink of an eye, and where the actions of a few can have ripple effects across the globe. Throughout history, there have been periods of remarkable growth and prosperity in financial markets, times when it seems like everyone is winning and the good times will never end. These periods are often followed by sudden and dramatic downturns, leaving investors bewildered and wondering what went wrong. These cycles of boom and bust are a recurring theme in financial history, and at the heart of these cycles lie the enigmatic phenomenon of financial bubbles. Financial bubbles are characterized by a rapid surge in the price of an asset or a class of assets, driven by speculative fervor rather than fundamental value. These bubbles can be incredibly alluring, promising quick riches and attracting investors from all walks of life. However, their allure is often deceptive, as bubbles are inherently unstable and prone to bursting, leaving behind a trail of financial wreckage. Understanding financial bubbles is crucial for anyone who wants to navigate the world of finance successfully. Whether you are a seasoned investor or just starting, it is essential to recognize the warning signs of a bubble, understand the factors that contribute to their formation, and learn from the lessons of past bubbles. Financial bubbles often follow a predictable pattern. Understanding this pattern is key to protecting ourselves from their consequences. At the heart of every bubble lies a disconnect between price and value. Prices become detached from fundamentals, driven by speculation and herd behavior. This creates a self-fulfilling prophecy, inflating the bubble further. Throughout history, financial bubbles have unique characteristics and lessons. The Dutch Tulip Mania of the 1630s is a famous example. Tulips' beauty and rarity made them highly sought after. Prices soared, reaching astronomical levels. The bubble burst, leaving investors financially ruined. Another example is the South Sea Bubble of 1720. The South Sea Company's stock soared, then crashed. Studying these bubbles helps us recognize patterns and avoid past mistakes. Just as a fire requires 3 essential elements to ignite and burn, financial bubbles also rely on a specific set of conditions to form and inflate. This concept is often referred to as the fire triangle of financial bubbles. The 3 sides of this triangle represent marketability, money or credit, and speculation. When these elements converge, they create a potent mix capable of igniting a financial bubble. Marketability refers to the ease with which an asset can be bought and sold. Money or credit acts as the fuel that feeds the bubble's flames. Speculation, the most volatile element, acts as the oxygen that sustains the bubble's growth. Understanding these elements is crucial for recognizing financial bubbles. Marketability, the ease with which an asset can be bought or sold, plays a crucial role in financial bubbles. High marketability attracts more investors, creating a liquid market. This liquidity can make assets more susceptible to speculative bubbles. Imagine technology stocks generating buzz. Early investors drive up prices, attracting more investors. The ease of trading fuels rapid price appreciation. This can lead to a self-reinforcing cycle of buying and selling. Understanding marketability's role in bubbles is crucial for investors. While marketability paves the way for a bubble to form, it is the availability of money and credit that often acts as the fuel, propelling asset prices to dizzying heights. When credit is cheap and readily available, investors are more likely to borrow money to invest, leveraging their bets and magnifying their potential gains and losses. This increased purchasing power, fueled by low interest rates and lax lending standards, can create a powerful feedback loop, further inflating the bubble. Central banks, through their monetary policy decisions, play a significant role in influencing the availability of credit in an economy. When central banks lower interest rates to stimulate economic growth, it can create an environment where borrowing becomes more attractive. Investors, enticed by the prospect of cheap credit, are more likely to take on debt to invest in assets, hoping to capitalize on the rising tide. This increased demand for assets, fueled by borrowed money, can push prices up even further, creating a sense of euphoria and invincibility. As asset prices rise, lenders often become less risk-averse. offering even more credit to investors, further fueling the speculative frenzy. This cycle of rising prices and increased lending can continue for some time, creating a dangerous illusion of sustainable growth. However, just as a fire cannot burn indefinitely without more fuel, financial bubbles are unsustainable without a continuous influx of new money and credit. When interest rates rise or lending standards tighten, the flow of easy money can dry up, leaving investors exposed and vulnerable. The once booming market can quickly turn sour, as investors faced with margin calls and mounting debt are forced to sell their assets, leading to a sharp decline in prices. Speculation, driven by greed and fear, acts as the oxygen that feeds the flames of a financial bubble. It is the belief that prices will rise indefinitely, driving irrational decisions and pushing markets to unsustainable heights. Fueled by herd behavior and media hype, speculation can turn a rational market into a casino-like atmosphere. As the bubble inflates, speculation takes on a life of its own. History shows that speculative bubbles, no matter how euphoric, are ultimately unsustainable. Tulip Mania, the flower that bloomed into a frenzy. In the 1630s, the Dutch Tulip Mania became one of the earliest financial bubbles. Tulips, originally from Central Asia, captivated Europe with their vibrant colors. The Netherlands embraced tulips, and their prices soared. Speculation drove prices to unimaginable heights. In 1637, the market collapsed, leaving many financially ruined. The South Sea Bubble of 1720 was a financial disaster that shook England, highlighting the dangers of speculative excess and unchecked corporate power. The South Sea Company, granted a monopoly on trade with the South Seas, fueled a speculative frenzy. The public, eager for riches, rushed to buy shares, driving the stock price to unsustainable heights. When reality set in, the bubble burst, causing financial ruin and widespread panic. Railway mania in the 1840s gripped Great Britain, showcasing how transformative technology can drive both progress and instability. Railways promised to revolutionize transportation and connect markets. Investors' excitement led to a wave of speculation. Parliament facilitated capital raising and land acquisition. Low interest rates and a booming economy fueled speculative excess. Hundreds of new railway companies emerged. Stock prices soared to unsustainable levels. Many projects were poorly planned and financially unviable. The bubble burst, leading to a market crash. Despite the crash, it laid the foundation for a robust railway network. The Roaring Twenties, a decade of economic prosperity and cultural dynamism, culminated in the devastating stock market crash of 1929. This period, marked by technological innovation and social change, illustrates how speculation and unchecked optimism can lead to disaster. The stock market experienced a sustained bull market, with stock prices rising steadily. Credit was readily available, fueling consumer spending and speculation. Stock prices soared, driven by a speculative frenzy. The bubble burst in October 1929, leading to the Great Depression. Japan's economic miracle, a period of rapid growth and technological advancement, came to a halt in the 1990s with the bursting of its asset price bubble. This ushered in the lost decade, a cautionary tale about unchecked asset price inflation and excessive leverage. The collapse had long-lasting economic consequences. The anatomy of a financial bubble, while unique in its specific details and context, often follows a remarkably consistent pattern, a cycle of boom and bust driven by a potent mix of human psychology, market dynamics, and often external events. Understanding this anatomy, the stages that characterize a bubble's life cycle, is crucial for investors and policymakers alike in recognizing the warning signs and mitigating the potential damage of these speculative episodes. The first stage, displacement, often begins subtly with a shift in the economic landscape, a technological breakthrough, or a change in government policy that creates new opportunities for profit and attracts the attention of investors. This could be the emergence of a new industry, such as the rise of railroads in the 19th century or the dot-com boom of the late 1990s. Or it could be a sudden shift in resource availability, like the discovery of gold or oil. This initial displacement creates a fertile ground for speculation. as investors, sensing the potential for outsized returns, begin to allocate capital to this new and exciting sector. News of early successes spreads, attracting more investors, and the market begins its ascent, often gradually at first, driven by a combination of genuine excitement and a growing fear of missing out. At this stage, the fundamentals of the market may still be relatively sound, with prices reflecting the underlying value of the assets being traded. However, as more investors enter the market, drawn in by the allure of quick profits, the stage is set for the next phase of the bubble's life cycle, the boom phase. Section 2. The boom phase. Riding the wave of optimism. The boom phase, characterized by accelerating price increases, heightened media attention, and a growing sense of euphoria, is where the bubble truly takes shape, often captivating the imagination of the public and drawing in a wider pool of participants, many of whom may be new to investing or unfamiliar with the risks involved. As prices rise, fueled by a combination of increasing demand and readily available credit, investors experience the thrill of quick and seemingly easy profits. Success stories abound, further fueling the speculative frenzy and attracting a new wave of investors eager to get in on the action. The fear of missing out becomes a powerful motivator, driving people to invest, even if they don't fully understand the underlying assets or the risks involved. During this phase, the market often decouples from economic fundamentals, with prices rising not because of any intrinsic value increase in the underlying assets, but simply because of the self-fulfilling prophecy of rising expectations. Investors, caught up in the excitement, begin to believe that prices will continue to rise indefinitely, justifying their ever riskier bets with the assumption that they can always sell to someone else at a higher price later on. The media, often complicit in fueling the bubble, amplifies the sense of euphoria, highlighting success stories and downplaying risks. Financial analysts, eager to capitalize on the bull market, issue optimistic forecasts, further reinforcing the belief that the good times will never end. The boom phase, while exhilarating for those who ride the wave early on, sets the stage for a dangerous climax, the peak of the bubble. Section 3. Euphoria and irrationality. The peak of the bubble. The euphoria phase, the peak of the bubble's life cycle, is a time of both exhilaration and extreme risk, marked by a dangerous mix of overconfidence, herd mentality, and a widespread belief that this time is different. Logic and prudence are often abandoned as investors, swept up in the speculative frenzy, engage in increasingly risky behavior, convinced that the party will never end. Prices reach unsustainable levels, driven purely by speculative demand and a fear of missing out. The market becomes a casino-like atmosphere, with investors often making decisions based on rumors, tips, and gut feelings rather than sound financial analysis. New and untested investment products are introduced, promising even greater returns, further fueling the speculative fire. During this phase, the disconnect between price and value reaches its zenith. Assets that were once considered niche or speculative become mainstream, their prices driven to astronomical levels by a combination of hype and herd behavior. The media, often caught up in the excitement themselves, contributes to the frenzy, showcasing stories of overnight millionaires and promoting the idea that anyone can get rich quick. However, like a fireworks display that reaches its peak before fading into darkness, the euphoria phase is inherently unsustainable. The music eventually stops, and reality sets in. The very factors that drove the bubble's ascent, easy credit, speculative fervor, and a willingness to overlook risks, sow the seeds of its inevitable collapse. Distress, denial, and the inevitable crash. The distress phase starts subtly, with unease creeping into the market as some investors begin to sell. This selling pressure is often met with denial, as others dismiss the downturn as temporary. As prices decline, the market mood shifts. Media coverage turns cautious, then negative, highlighting ignored risks. Analysts revise forecasts downwards, eroding investor confidence. Fear of missing out is replaced by fear of losing everything. Investors, facing losses and margin calls, sell at a loss. This creates a vicious cycle, further depressing the market. The crash is swift and brutal. Prices plummet, leaving investors in shock. Liquidity now works against investors, making it difficult to sell assets. The collapse can have far-reaching consequences for the broader economy. Banks with bad loans may become reluctant to lend, leading to a credit crunch. Businesses may cut back on investment and lay off workers. The bursting of a bubble can trigger a recession or even a depression. The relationship between governments, central banks, and financial markets is complex and often contentious. Free markets argue that supply and demand, without government interference, is the most efficient way to allocate resources. However, history shows that financial markets are not immune to excesses, leading to speculative bubbles with devastating consequences. Governments and central banks balance market freedom with preventing financial crises. Excessive intervention can stifle innovation, while too little can leave the economy vulnerable. Moral hazard refers to the tendency for individuals or institutions to take on greater risks when they believe they will be protected from the negative consequences. In financial markets, this can happen when investors expect government bailouts. This belief encourages excessive risk-taking and speculative bubbles. The 2008 financial crisis illustrates the dangers of moral hazard. Belief in bailouts led to excessive leverage and risky investments. Post-crisis measures included bailouts and new regulations. However, these interventions created new moral hazards. The too-big-to-fail doctrine fostered a culture of moral hazard. Financial bubbles are deeply intertwined with human psychology. Herd mentality drives individuals to follow the crowd, even against their own judgment. This creates a self-reinforcing cycle of speculation. As prices rise, media attention draws in more investors. They join not because of due diligence, but because everyone else is making money. The fear of missing out becomes a powerful motivator. This herd behavior can lead to a dangerous disconnect between price and value. The market reflects collective mood, driven by emotion rather than logic. As the bubble inflates, prices can reach dizzying heights, far exceeding intrinsic value. Herd mentality fuels financial bubbles, but other psychological factors can worsen this, making rational decision-making tough. Media hype acts as an echo chamber, amplifying biases and emotions that drive speculative excesses. During bubbles, media focuses on market positives, promoting get-rich-quick stories. Competing for attention, news outlets may sensationalize stories, downplaying risks. Positive coverage can distort market views, encouraging risky investments. Constant positive news creates urgency, driving hasty investment decisions. Technological innovation can drive bubbles by creating exciting investment opportunities. New technologies generate hype and speculation, attracting eager investors. Media amplifies tech hype, showcasing potential while downplaying risks. This mix of innovation, media hype, and herd mentality drives unsustainable asset prices, leading to painful corrections. The history of financial bubbles, from the Dutch Tulip Mania to the dot-com crash to the more recent cryptocurrency frenzy, offers a sobering reminder of the perils of unchecked speculation. For individual investors, the most crucial lesson is the importance of discipline and a long-term perspective. Diversification remains as relevant as ever. By spreading investments, investors can reduce their exposure to risks. Another crucial lesson is the importance of skepticism. Critical thinking is essential during times of exuberance. Governments and regulators play a crucial role in mitigating the risks of financial bubbles through regulation and transparency. Central banks can influence bubbles through monetary policy, balancing interest rates to manage economic growth. Ultimately, mitigating financial bubbles requires prudent regulation, sound policy, and greater financial literacy. Financial history, as we've explored, is replete with tales of booms and busts, of soaring aspirations meeting the harsh reality of market cycles. From the tulip fields of 17th century Holland to the tech-fueled frenzy of the dot-com era, the patterns repeat, revealing the enduring interplay of human psychology, market dynamics, and the constant allure of quick riches. While the specific assets and technologies may change, the underlying forces driving these speculative episodes remain remarkably consistent. As we've seen, financial bubbles are not merely abstract economic phenomena. They are deeply human stories. They reflect our innate desires for wealth and security, our susceptibility to fear and greed, and our tendency to follow the crowd, even when our better judgment tells us to be cautious. Understanding these psychological underpinnings is crucial for anyone seeking to navigate the often turbulent waters of financial markets. While the bursting of a bubble can be a painful and disorienting experience, it also serves as a stark reminder of the importance of fundamental value, prudent risk management, and a long-term perspective. As Warren Buffett famously quipped, "Only when the tide goes out do you discover who's been swimming naked." The aftermath of a bubble exposes the excesses and vulnerabilities that were masked during the boom, offering valuable lessons for those willing to heed them. While bubbles may be an inevitable part of the financial landscape, understanding their dynamics, recognizing the warning signs, and learning from the mistakes of the past can help us mitigate their impact and make more informed investment decisions. By embracing prudence, discipline, and a healthy dose of skepticism, we can strive to become more informed and resilient participants in the ever-evolving world of finance.